the Federal Reserve Bank in the US is about to bring the pain. Earlier this week, they increased interest rates by 0.5% to a range of 4.25 to 4.5%. And while 0.5% was a smaller increase than the previous 4, which were 0.75%, they also signaled that interest rates were going to rise further than previously expected. And I can tell you right now that the Federal Reserve is not going to mess around with inflation. Because on top of all this, they projected that unemployment was now going to be higher than previously expected and that it was going to remain high for longer. And while inflation seems to be subsiding from 40-year highs, it is still at 7.1%, which is well above the range that the Federal Reserve is looking for. So as a result, you can expect that interest rates are going to go higher, they're going to be higher for longer, and the Fed, like I said, has every intention of bringing the pain. But before we get into all the details, my name is Noel Mathias, and if you want to thrive financially, this is the place for you. So go ahead, click that subscribe button and hit that like button so more people like you can see this video. Okay, so let's get into it. Let's start by talking about US inflation because it is down to 7.1%. This is off of 40-year highs that happened earlier in the year, and this is good news because it's starting to feel like the interest rate increases are starting to have an effect and that inflation will at some point in 2023 become something that is more reasonable. However, that doesn't mean that the Fed is going to take their foot off the gas pedal when it comes to raising interest rates. And the reason for this is simply because they want to avoid psychological inflation. This is where consumers start to expect inflation so much that it just becomes ingrained in the economy and higher interest rates start to lose their effect. Now, the good news is as of right now, it seems that there's some interest rate sensitivity with respect to inflation and that the higher interest rates are having a positive effect. So let's jump in here and take a look at the news and see what's going on because US inflation has slowed as fuel costs start to come down. And if you have been driving around, whether it's in Canada or whether it's in the US, you have definitely noticed that fuel costs are going down over the last month or two. But at the same time, certain costs are starting to rise. Things like housing, things like groceries are continuing to go up. And the primary reason that housing is continuing to go up in the US is because even though prices are starting to come down, the higher interest rates involved with obtaining financing are increasing the cost of owning a home quite significantly. And housing cost increases are something that you would expect to happen. Even though you may start to see housing prices fall, you have the total costs that start to increase as inflation increase. And this is the whole point of increasing interest rates, is more expensive items, things like cars and so on and so forth, that you need to borrow money in order to purchase become more expensive. And as a result, the demand starts to shrink for those things. And as you shrink the demand for those things, then the actual prices, the real prices of those goods starts to go down. And that's where you start to get inflation numbers that start to weaken. And for all intents and purposes, this seems to be working. However, with the situation that the Fed doesn't want to find themselves in a few months down the road is where they have told people, hey, we're going to slow down the interest rate increases. And as a result, people start to relax, they start to spend again, and inflation starts to run amok. And the Fed's position on this, saying that interest rates will continue to go up, is contrary to places like Canada, where the central bank there has said we are going to slow down the pace of interest rate increases, or at least given a pretty good indication of that. Now, there is a case to be made for the fact that Canada has higher sensitivity to interest rate increases, and that is primarily due to the fact that their mortgage market operates differently. So in Canada, the large majority of Canadians choose variable rate mortgages. These are mortgages that fluctuate with the Bank of Canada rate. And as a result, people who are buying houses feel the pain of higher interest rates and higher borrowing costs. But at the same time, people who already own houses and have chosen a variable rate mortgage also feel the pain as their interest rates and their payments start to rise while interest rates increase. And on top of that, the majority of mortgages in Canada are 5-year fixed mortgages, which means they're essentially 5-year adjustable mortgages. So the interest rate increases are typically felt within a 5-year period, as opposed to in the US, where if you have a 30-year mortgage, you won't feel that interest rate increase on your housing costs at any point in the future unless you get rid of that mortgage and move up to a bigger house or subsequently a bigger mortgage with a higher interest rate. Now, the real news here is the fact that the Federal Reserve has been very clear that they are going to weigh down the economy more aggressively than previously expected. In other words, they thought that the interest rate increases that they have done would do the job. Now they're saying we're going to go just a little bit further to make sure that the job actually gets done. And the way that you can be sure that they're going to do this is in the fact that they have forecasted higher unemployment. And what it means when a central bank forecasts higher unemployment is that they're going to intentionally do a little bit more damage to the economy in order to make sure that that inflation rate comes down. Because what happens when central banks increase interest rates is they don't intend to take 5% out of everybody's pockets. No, what they're actually doing is they're going to make it so that 5 to 10% of the people actually don't have the means to pay for anything. Now, I know that sounds a little bit crass, but in order to really reduce demand, you can't just take a little bit out of everybody's pocket. You have to make it so that a certain percentage of the population doesn't actually have the funds to go out and buy things that they don't need. And the way you do that is by increasing interest rates to the point where job losses start to happen. And the unfortunate thing about higher rates of unemployment is once you start to get higher rates of unemployment, it becomes very, very difficult to rein it in, which is why the Federal Reserve is now predicting higher rates of unemployment for a longer period of time. And I want to take you in and I want to show you the actual charts from the Federal Reserve and show you exactly how much their forecasts have changed. So let's start first and foremost by looking at the federal funds rate. This is this part of the chart right down here. And this is really key because what they've done is they revised their predictions from September and they've increased them up pretty much across the board. And this is the one that is really, really important because in 2023, previously they had expected interest rates to go up to about 4.6%. Now they're expecting those interest rates to go up to 5.1%, which means that they're going to increase interest rates by at least another 0.5 point, and more than likely by the end of 2023, I'm going to suspect that interest rates are going to go up by a full 1%. And on top of that, they've decreased their GDP projections. So in other words, they expected the economy in 2023 to grow at 1.2%. They're now expecting it to grow at only 0.5%. And it is very likely that this could be even lower than that if the economy enters into a recession. Now, here's the really, really important chart though. This is the unemployment rate projections. And what you can see is that they've raised this pretty much across the board. Now, when they go and they raise these projections and they say, well, we're expecting unemployment to go from 3.8 to 4.6. Well, what that tells us is that they're expecting that there's going to be some pain for employees. And the real problem here is that this is going to widen the wealth gap because it is going to be the people who earn the lowest amount of money that are most affected by higher unemployment, which means that the people who suffer the most are really, really, really going to suffer. And on top of all this, if you take a look at their projections with respect to inflation, they're not expecting inflation to come back down to that 2% range until well into 2025. And my guess is it could take longer than this. In fact, I'll link to a video at the end of this one, which explains why I think that inflation is going to stay high for at least a decade. But the reality here, based on all of their predictions, is that we are probably not going to see any rate decreases in 2023 as previously expected, and it'll probably be well into 2024 before we do start to see those interest rates come down. Now, I talked a little bit about Canada earlier, and why is there such a divergence from what's happening in Canada? Well, like I said, there seems to be significantly more sensitivity to higher interest rates in Canada. But that being said, if the Fed continues to increase interest rates, Canada will also find itself in a situation where it needs to start increasing interest rates further as well. The reason why is because if the US becomes a more attractive place to invest because of higher interest rates, that will mean that our dollar will continue to go down in value, meaning imports will become more expensive, which will have further inflationary effects on the Canadian economy. Now, the question here is, what do you do to combat inflation? Well, the obvious things are to buy things when they're on sale and only the things that you need. Maybe stop spending as much money and investing more. Things like real estate, things like stocks and equities, especially in 2023 after the year that we've had in 2022, are going to continue to be very, very, very good investments. But on top of all that, while the labor market is hot, while it continues to be a market where you can get a better job at a higher rate of pay, now seems to be the time where it makes the most sense to invest in yourself, in your skill set, and look for better opportunities from an employment perspective. Because the one thing that will definitely help you with inflation is if you can make big jumps in your income. And the best way to do that is by looking for better jobs within your existing company or looking for other companies who are looking for people who have your skill set and who are willing to pay more in order to get it. And that by far is the single best way to fight inflation. Invest in yourself, get better at what you do, and earn more income. And on top of that, if you don't feel comfortable or for whatever reason you feel like you're capped out on your income and your job, there are all sorts of side hustles that you can do in order to make extra money. I have friends that have YouTube accounts that are making $25,000 to $50,000 extra a year. I have other friends who have started eyelash businesses who are making $15,000 to $25,000 extra per year. And we have clients who have started house cleaning businesses who are earning exceptional amounts of money so much so that they've quit their existing jobs. So the question is, what will you do in order to improve yourself, in order to earn more income so that you can find yourself in a situation where inflation and higher interest rates become irrelevant because you chose to make them so?